And we're here today with Andy Blanchard. Thank you, my good sir, for taking some time and speaking with us today.
Not a problem. Glad to be here.
For those watching, Andy, you've been in the sector for quite a long time in the equity markets and investing, spending almost 30 years, or exactly 30 years, I think you were saying, as VP with IPC Securities. You're now a financial planner, but still incredibly involved in what's going on with the markets, and that's what we're calling you today about is what's going on right now.
Not a problem. I probably start off with sort of an interesting quote, and that's basically many years ago, there was an individual that said that October was the most dangerous month of the year, right along with January, February, March, April, May, June, July, August, and September, November, and December. And it really doesn't mean anything. But what we see, and all I'm doing is talking from my past experience, and specifically not saying anything with regards to investing today. But what we see in the fall is what they call window dressing. Window dressing is where the portfolio managers start to clean up their portfolios, because at the end of the year, they are basically going to be rated by the different ratios and formulas that the managers are scrutinized with, and they're trying to make themselves look prettier. And they call that window dressing. So we see that happening year over year over year, and it's always a fall right up until December where the portfolio managers are making changes. And one of the interesting things as a personal investor, I read a market piece from EdgePoint, and they provided a very interesting chart, and that is if you subtract the big six from the S&P, that's Alphabet, Amazon, Apple, Facebook, Microsoft, and Netflix, the market has actually only returned a 1.5% negative return from January 1st to April 30th. So this really hasn't been a bull market. It's been a bear market for over a year now. And what we're seeing is the big six correcting, and now we're seeing a flight to quality. The tech market is a sector market, and people are flying from the sector right now, and they're moving to good quality investments.
Yeah, and it's interesting that you note that, because those massive companies have clearly massive market caps, and they're really, what happens to them, I mean, those companies like Amazon and Facebook and all these other, it's funny, they've become almost their own indicators. You talk about whether the S&P 500 is red or green, you talk about certain sectors, but then people are like, oh, Amazon red, that's why. One company has that much power. And I know Amazon, I think on Thursday, so I think tomorrow or Friday, they have their earnings, and Facebook just came out with theirs yesterday. It missed the expectations on revenue or revenue growth, one of those two metrics, but it did beat it on earnings per share. So I actually haven't had a chance to look at it today to see if that's helping us prop up, but it's interesting that you note that, because it's a lot of people are asking themselves, a lot of our viewers are in cannabis stocks and mining stocks, but they invest in other things as well, and it almost looks like capital is just fleeing right now. And you said, one of those aspects could very well be this window dressing, where, those sectors I just said are very, very speculative. If you're getting ratings on how safe your investment is, you probably don't want a huge allocation of that in your investment portfolio if you're a big fund manager.
Absolutely. It's a crucial measurement that comes out in January. And when they look at those portfolio managers and they see what their rate of return is versus the amount of risk that they took, it all boils down to putting all of the managers on the same measuring stick. And if you're getting a 10% rate of return, but you took high risk to get it, you're really not a great manager. So ultimately, when I reflect on my career, We look at portfolio managers who sort of did the straight and narrow road, the investing in quality, producing consistent returns year over year over year without taking the big leaps into the big six or whatever the flavor of the year is or the month is.
Yeah, and it's hard, right? It's hard as a manager. You have to. Some people don't fully understand. I don't fully understand the life of a fund manager, because when I'm looking at my investments, I'm a very, very risk averse person. I don't mind seeing my portfolio fluctuate within sometimes like 20% in a day. If you're a fund manager and your portfolio is fluctuating 20% a day, I think you're not going to have your job for too long if that's the type of risk that you're taking.
Exactly. Ultimately, people don't mind taking risk when they're fairly young, but the stress test is, and people just don't realize the stress test, but it's a very simple stress test. How much money are you prepared to lose at the casino in a single day? Okay, are you comfortable with losing $10,000 this afternoon at the casino? And most people will say no. And then I would ask them, when I was working full-time as an advisor, then why are you trying to take that kind of risk in your portfolio?
Mm-hmm.
Okay, and if you can answer that stress test question, then it becomes very simple where your money goes.
Yeah.
And managing it yourself, well, that's okay for some people, but ultimately, you got to be honest with yourself and say, would you go to the casino and do that?
Yeah, and I think a lot of people, when you, going back to just cannabis specifically, we watched legalization come through on October 17th, and a lot of people were saying, why would it be selling the news? Everyone knows the news. Well, no, if that mentality is still in there, I almost promise you institutions are going to push for that. But I don't think anyone really thought there would be such a drastic pullback in this. And I think that kind of goes back to what you were saying, where you get a little bit of a pullback with institutions selling and maybe lightening their load. Then possibly you're hitting some stop losses on the way down. Then panic starts to ensue. Then the market's losing its security or its trust in what's happening. You've got these big six starting to correct a little bit as well. You've got S&P 500. You've got the NASDAQ. All these things all at once are coming down. But when that next push, that I can't believe it just went 20% 2 days in a row. I really think that next push are those people that you're talking about, where they're just like, I can't take it anymore, and they finally just sell. And it's unfortunate because they're doing it off of fear, and probably they overextended themselves and they didn't quite do that type of a stress test, saying, can I watch my portfolio go down by this much? Clearly no, but they found that out when they're already down 35, 40% and just couldn't take the stress anymore.
Yeah, I reflect back on 2008 when the market was down big double digits, and the interesting thing is the people who actually stayed the course and invested more when the market was down came out of that market looking absolutely wonderful. One of the things that I've noticed over the years is that the people who seem to do really, really well in the market are the ones that are consistently investing in blue chip stocks with high dividends. Specifically, a great example is the banks. The banks seem to increase their dividend almost yearly, and every several years to 10 years, they seem to split. And if I reflect on anyone that walked in the door when I was working, who bought bank stocks or utilities or anything like that back in the 50s and the 40s, and they came to see me in the 80s, they were multimillionaires just because their stocks split and the dividends reinvested, and they got more and more and more money and growth over the years than the markets actually returned. And this is for a very interesting reason. The indices are what they call survivor indexes. So the indice today, for instance, the S&P 500 or the TSE or any of those markets, they're only a reflection of the current stocks that are in that indices, but not a reflection of what was there 10 years ago or 20 years ago or 30 years ago. The only thing that's consistent in there is the blue chip, big dividend paying stocks that have just been around forever. a Canadian bank that's been around for over 100 years, that sort of thing.
Yeah, and I'm glad you brought that up actually, because I mean, for myself, I am not in any of those stocks, and I understand why I'm not, because I'm very honest with where my portfolio is, where I'm at. I spend a lot of time thinking about it. But there's a lot of people out there who I strongly believe, because of cannabis, are investing for their first time. I mean, I've spoken to people at TD, at Questrade, and it was amazing how many different people told me that they had so many different TFSAs, like record amount of TFSAs opened up and all these different things, and they're all saying that they're going into cannabis. But the reason why I'm glad you brought that up is that we have a lot of investors right now who are so used to this high flying, make 15, 20% in a week or whatever it be. I always like to stress to them, I really don't believe that's normal. That's not normal. If you are making good money, you have to understand it's okay to have a few high flyers, but you've got to find a time where you start putting a little bit of your money into more stable investments that can grow over time, and stop thinking about a double tomorrow. Start thinking about constantly doubling your money over the course of the next like 15 or 20 years. And banks, I've heard from so many different people now, banks are constantly having returns, and it's the dividends as well that over time, as those grow, you start getting exponential amount of money coming into you. And I think more people need to look into that.
Well, there's lots and lots of opportunity in the market, and there are great rules of thumb. And the one rule of thumb, I was always a contrarian when I was an investor in the market. You have to go. There's an old, if I remember the ratio, 2% of the people walk away with 98% of the money on the market. So if you're investing with the 98%, you're going to lose your money. If you're investing with the 2%, you're going to walk away with everybody's money. And you think about that's a really profound statement, which states that you have to be a contrarian, because if you're a contrarian, you're with the 2%. If you're investing with the market, then you're in danger zone because somebody's out to take your money.
Yeah, I'm a firm believer that once I start seeing it on all the different Facebook channels, on Twitter, on CNN, on Fast Money, and all these different, as soon as I start seeing it get into all these different avenues, I already know that the good money's been made, and now they're just looking for liquidity events. So I'm slowly learning myself as well. But we got to go for today. I appreciate you coming on the show. It's nice to get the opinions of people who have been through this for not just one cycle, but for decades, looking at how money is traded from one hand to the other. So I appreciate your time. We'd love to have you on the show again in the near future. And again, just thank you for coming on today.
Great, Brandon. Thank you very much. It was fun.
Absolutely.